Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 10, Personal Finance and Investing. A good resource for this chapter is chapters 9 and 10, Principles of Finance with Excel, second edition by Beninga. And those chapters will cover portfolio risk and return. In this topic, we're going to talk about personal finance, and we're going to use an example of Jordan. Jordan is 30 years old, married, and expecting a child any day. Jordan's spouse does not work, and Jordan wants to estimate their emergency fund, how much life insurance to get, college savings, and retirement savings. And here's a preliminary budget. Jordan makes $100,000 a year, pays 31% in total taxes, saves 12% of their income, so that's 43% of their income goes to either savings or taxes. So that leaves 57% of her salary is actually consumed. When you think about a disposable income or consumption. And that means $57,000 is actually consumed. Let's assume that she has housing expense of 25% or $25,000. It's 25% of $100,000. Therefore, if I take the $57,000 and subtract $25,000 housing, Jordan is actually living on non-housing consumption of $32,000. That becomes later when we talk about transitioning into retirement. So bottom line is she is living on $32,000 after taxes, savings, and housing. So let's talk about an emergency fund. How much should Jordan set aside in case she loses her job? This budget is the same as the last slide. So what I'm going to suggest is one way of thinking about it is think about how many months would it take you to get a comparable job. And that may vary based on the position you have and how high you're up. So let's say that Jordan estimates she'll need 6 months to replace her job. So what we can do is we can calculate the present value of 6 months of consumption. And that should be set aside in an emergency fund. So let's go to our worksheet. So again, all this is still the same. So what I'm going to say is I'm going to put aside 6 months of income. Now I could just take the 57,000 divided by 12 and multiply it times 6, but it's not going to be quite so much because we'll assume that she gets 1% savings. So we're going to do a PV. And I'm going to do the present value of a 6-month annuity where the interest rate per month is 1% divided by 12. Number of periods are 6. And then for the payment, I'm going to do minus 57,000 divided by 12. And now the only reason I'm doing that is this is all going to be monthly. So I have the monthly interest rate, the number of months, and I want the monthly payment is going to be 57,000 divided by 12. That tells me that she needs to put aside $28,417. That'll allow her to live comfortably, paying the mortgage or rent and buying clothing and food and everything she needs while she looks for her job. And if I take that $28,000 divided by her monthly salary, it's about 3 to 4 months of her salary, pre-tax salary, is being put into an emergency fund. Just maybe deposit it in savings. So that's an easy one. How much does she need to set aside for an emergency fund? $28,000, or about 3 to 4 months of salary. Next one, life insurance. Let's say that Jordan's spouse does not work and is maybe going to raise the child. So we want to think about, well, how much money should we set aside or get an insurance policy on in case of Jordan's death? And what we'll do is we're going to go to the worksheet. This is all the same. And one way I'm going to suggest a way of thinking about life insurance that many people use to think about life insurance is they're going to pay off the mortgage and replace some amount of years of income, maybe as the spouse raises the child. So what I'm going to do is say initially I want to at least pay off maybe a $500,000 mortgage. So you want to have at least $500,000 so the house is paid off. Now let me change the color of this so we can see the formula a little bit better. So I got $500,000. Now I'm going to add to that a present value of 20 years. That seems a lot, but we're going to have 20 years of living here without worrying about money. So we'll do the present value. Let's put in the interest rate. We'll assume the annual interest rate is 2.5%. We'll say 20 years. And let's go ahead and do a non-housing consumption is the amount I want to replace. Because in other words, the house is already paid off. So what we need to really replace is this non-housing consumption. We want to do a comma, and where it says future value, after 20 years, there's no money left over. And the last one talks about end of period or beginning period. I'm just going to make it a beginning of period. In other words, I want to make sure that the spouse, the surviving spouse, is paid immediately. He doesn't have to wait 1 year for her money or his money. I'm going to actually make sure also that that payment is negative because I want that present value to show up as a positive number. All right, when I do that, the amount of insurance should be $1,011,000. So what that represents is $500,000 to pay off the house, and then the present value of $32,000 a year for 20 years at 2.5% must have been the $511,000. So it looks like Jordan needs to get $1 million policy, which is about 10 times her income. Now let's talk about college savings plan. I said that Jordan's expecting a baby any day now. And what we're going to do is we're going to assume that this baby is going to be sent to a state university that currently costs $27,500. However, this person's going to start college. That should be 18 years. This child is going to start college in 18 years. No, they're not going to spend 4 extra years in first grade. So 18 years from now, college will start. We're going to assume that college tuition grows at 2.5% a year. And let's have an initial deposit. Say the day the child's born, you get maybe a savings bond or something worth $1,000. The question is, how much do you need to save every year for 21 years in order to pay off college? Let's go to the worksheet. So the first thing I'll do is look over here. I have years 0 through 21. So this is the child's life. Year 18, the child starts college. How much is college going to cost? Well, I have here that it costs $27,500 now to go to the college you think the child would like. And then I have that growing by the 2.5% college inflation. So you can see 18 years from now that college should cost $41,000, then $43,000, $44,000, and $45,000. Those are going to be my outflows. All right, so I have that right here as the cost of college, and what really matters are these last 4 numbers. That's when my child is going to go, or Jordan's child is going to go to college. So let's figure out how much do we need to put away today. Let's assume that they put $5,000 a year towards college, and we'll see if that's enough money. Again, I just made the assumption someone gave you $1,000 to start your savings account. Now I'm going to use this asset allocation here that starts off 75% stock or equity, 25% bond and no cash. And then year 6 through 10, it goes to 50-50, stocks and bonds. Years 11 through 15, it's going to go 25-75. And then year 16 through 21, it's going to go 50-50 stocks and bonds. And I got this from a Vanguard 529 moderate risk glide path. In other words, a 529 are savings plans that give tax advantages. The earnings on the portfolio grow tax-free. And if you enter into this Vanguard moderate risk fund, it'll actually automatically adjust your portfolio so that it starts off with mostly stock and ends with mostly bond. So this is a good way of saving the money. So let's start this. Let's say that the first contribution is $5,000. Now we need to figure out what is the rate of return every year on the money. So what we could do is we can set up our portfolio here that in the first year, the expected return on the portfolio that's invested 75 equity, 25 bond, and 0 cash, that's going to be equal to 75% of my money earns, I'm going to assume 7.5% is the expected return on the stock market. That's my estimate. Plus 25% of your money earns, 25% of my money earns 2.5%. I'm going to anchor the 2.5%. Plus 0% earns 1%. I'll anchor the 1%. So I've anchored these cells here in row 9. So it looks like my portfolio will start out at 6.25%, and as it gets safer, away from stocks and into bonds, the return goes down. So let's now see what our portfolio is going to be worth at the end. So again, I made an assumption here. This is an input that I'm going to assume the first contribution is $5,000, and I made another assumption that the contribution is going to grow at 2% a year. So I'm going to put $5,000 away this year, then $5,100, then $5,200, just growing at 2% per year. Now, and I'm going to continue saving while the child's in college, while I may start making the payments. So let's see what happens to our portfolio over time. The first year, our portfolio starts at $1,000, and the first year of the child's life is invested in this portfolio here, 75-25-0, earns 6.25%. So that $1,000 is going to be worth $1,000 plus 6.25%, $1,063. But I'm going to assume that these are year-end contributions. On the child's first birthday, you put in a $5,000 in that 529 plan. So you have $6,063. And I'm going to do one more thing. I'm going to add to that number this withdrawal. Now, this is not going to have an effect till I get down to this cell here. So I'm going to copy that, go down, and what you see is the portfolio grows up to a high of $137,000 when the child is 17. The child is 18, you're still going to still be contributing, but now you're going to withdraw the first year's tuition and room and board, and then the second and third year. And it looks like we just didn't quite have enough money. At the end, we're $1,400 short. So one way of figuring out how much to save is just do a little simple goal seek. Data, what if, goal seek. Let's set the ending portfolio balance to a value of 0 by changing that initial contribution. Again, the initial contribution grows at 2% a year. And looks like we should start out at 5,041, and that'll grow by 2% every year. And if we do that, we had just enough money to make all the payments. So bottom line, it looks like you should be saving about $5,000 a year, every year, for a child's education at kind of a middle range tuition. So go back to the presentation. We're now going to talk about retirement savings. So let's think that Jordan is now 30, has saved only $10,000 for retirement, and has put it in a 401k account, which is a tax-deferred, a tax-benefited account. She plans to save 10% of her salary, and that's her salary is going to grow 2% a year. We're going to assume that Jordan invests in a target date fund, one of Vanguard's target date fund, which is a 2055 fund. All right, that 2055 fund, you can think about a target date fund where you just pick a date equal to roughly the year you're going to retire. Say your age, the year when you're, say, maybe 65 years old. And let's assume that Jordan is going to be 65 years old in roughly 2055. Now, these funds are only for every 5 years, so she could probably choose maybe a 2050 fund or a 2055 fund or a 2060 fund. The only difference is if you took a slightly different higher date, a 2060 fund, it'll just be a little bit riskier. So Jordan's going to put 10% of her salary every year into the 2055 fund. That 2055 fund I have here, this is what roughly the asset allocations will be throughout Jordan's life. And Jordan wants to know the expected return of the portfolio and whether she has enough money for retirement if she lives to 95 years old. All right, and another big assumption is when Jordan turns 66, all right, she retires at age 65. When she retires at age 66, she wants to start withdrawing money out of her portfolio to replace 50% of her ending salary. Let's go to the spreadsheet and talk about that. So we'll go to the retirement tab. And what we'll see is Jordan's salary starts at $100,000 at age 30. It starts growing at 2% a year. I just kind of hard-coded that in there. So by the time Jordan is age 65, she is making $199,989. Now I made an assumption here that in age 66, she starts withdrawing money out of her savings account. And she's going to withdraw 50% of her final salary, and then that grows at 2% a year. Now, the reason why I have that withdrawal grow at 2% a year is because of inflation. We want to make sure that she's not getting poorer every year. In other words, her withdrawals are going up with the rate of inflation. So this is what's going on. We need to figure out how Jordan will have enough money to pay herself these payments from age 66 to 95. What we're going to do is we're going to set up a portfolio that has certain asset allocations. We'll just use these for now. Again, these are based on the target date fund, and what you see is they get safer and safer as she gets older. and at some point they go into kind of a steady state of about, looks like about 70% bond and 30% stock once you get in your 70s. So let's talk about this portfolio. This portfolio has expected returns of cash, bonds, U.S. stocks, and foreign stocks, and I just used my best guesses that I have today. I assume that the money market fund or cash is going to have a return of 1%. I'm assuming bonds historically have been about 1.5% above cash, so I'm going to use 2.5. Stocks have been about 5% above bonds, so I'm going to use 7.5. And I'm going to just make an assumption that foreign stocks, say the rest of the world stocks excluding U.S., will be an extra 0.5% above that. Let's assume that Jordan's going to start saving 10% of her salary. She currently has $10,000 saved, and she needs to replace 50% of her income in retirement. Why 50%? Well, we can go back to her budget. She's already living on 57% of her income, right? Once you retire, taxes are going to go down. You're going to be no longer saving. So for those reasons alone, you probably only need to replace maybe 50 or 60% of your salary. In addition, most people receive some Social Security. Social Security could be 10, 20, 30% of your income for the rest of your life. So all those tell me that maybe if I replace 50% of my salary with just my 401k, right, the savings and taxes, the fact that I'm not saving anymore, and Social Security will kick in the other 50%. So I'm going to assume that she needs 50%. All right, so now I just need to get the portfolio return. I'll just do my weighted average return, 0%, earns 1%, anchor that. 10% of her portfolio earns 2.5%, anchor the 2.5%. 54% of her portfolio earns 7.5, anchor that. And the last one, 36% of her portfolio earns 8%, anchor that. So we're going to start off with 7.18. I'm going to double click, and this is the portfolio returns over Jordan's life. Now I have her salary growing. The contributions into the portfolio are always 10% of salary. That's the assumption right here. So let's figure out if Jordan's going to have enough money. So we're going to start off here. Let me expand this a little bit. We're going to say that the portfolio starts at 10,000. That 10,000 grows at 1 plus 718, the expected return of that portfolio. I'm then going to add the contribution. So she's going to get 7% return on 10,000. That's 10,700 plus deposit another 10,000. So she has 20,700. I'm going to copy that down. And let's stop right at retirement. This is age 65 right here. At that point, Jordan has saved $1.9 million. Notice my contributions turn negative at age 66 because these are the withdrawals that then grow at 2%. So all I need to do is just continue the formula down. And what you see is Jordan's portfolio will last till she's about 90 years old. So that's pretty good. If we want to have enough money to last till 95%, we could do a goal seek. Just set this data, what if, goal seek. I'll set that portfolio balance to 0 by changing the savings rate. And it looks like if Jordan saves about 11.5% of her salary, she'll have just enough money to make these payments. One little note on company matches. This 11.5%, which is a reasonable number. Actually, most financial planners I know kind of recommend if you start early in your 20s, mid-20s, you should save about 12% of your salary. Now, if your company is doing a match, say if your company saves matches your first 6% of savings, maybe you only have to save 6, and your company matches 6, and you get a total of 12. Or if your company matches the first 6, if you save 10. The company gives you another 6, and you'll save 16. All right, so we'll take that back to 10. So again, at 10, it'll last till about age 90 based on these assumptions. All right, so this is a deterministic model of savings. And it's deterministic only because it's pretending as if these expected returns can only be these values. All right. If I want to make this a probabilistic or stochastic model, I'm going to have to make returns random and then see if this portfolio still makes sense. Because again, think about the major drawback of this model. If I would assume that U.S. stocks and foreign stocks are the riskiest asset classes, and cash and bonds are the safest. However, nowhere in this portfolio does it show me that these portfolios, being all stock, are much riskier than these portfolios. So why didn't I just put all my money into the highest return asset? Right? Why didn't I just make all these zeros except for foreign stocks and 8%? That would make this portfolio look a lot better. So how to deal with risk is I'm going to have to do some kind of Monte Carlo simulation where I allow the returns to be risky. How I'm going to do that is I first need to assume that the portfolio returns are going to be normally distributed. I'm going to assume that each asset class return, cash, bonds, stocks, and foreign stocks, are normally distributed with these means. And then the portfolio is going to have this mean return. And then I'm going to calculate the standard deviation every year of the portfolio. Now I'm going to go through this kind of quickly, calculating a portfolio standard deviation. If you're interested in the topic, look at the textbook. Also, if you're interested in the topic, take a look at my other videos that I have. One explains how I calculate the portfolio standard deviation using matrix algebra. And also one explains how I'm going to do this little trick where I create a covariance matrix. But let me go back and go into the spreadsheet and do this. All right, so to get to portfolio, I need to get the portfolio standard deviation. And then what I'm going to do with that is do a Monte Carlo simulation. But to get to a portfolio standard deviation, what is the standard deviation of this portfolio? That's it starts off at 0, 10, 54, and 36% of these asset classes. It is not simply the weighted average. So this is the weighted average. I use the sum product function here, which just takes 0 times 1 plus 10 times 2.5 plus 54 times 7.5 plus 36 times 8. The sum product does the weighted average. I can't do that for the standard deviation. The standard deviation of a portfolio is not the weighted average because these assets don't move perfectly in line with each other. In other words, they're not perfectly correlated. In other words, there's a diversification benefit. When I add assets together, they're not perfectly correlated. Their risk is less than the weighted average. But I'll put that in there. Let me just put in the weighted average. I'll use my sum product function, which simply takes these weights times these standard deviations and takes the weighted average. So the weighted average standard deviation is 17%. But the risk is going to be a lot lower than that because these are not perfectly correlated. By the way, I got these standard deviations looking at some historical data sets that I had on these asset classes. So how am I going to get the standard deviation? Well, the standard deviation of a portfolio, by definition, if you look at the textbook, you can get more depth, is the square root of the double sum of the weights times the portfolio covariances. Now the portfolio covariance terms, a covariance between each asset is the standard deviation of each of the two assets times the correlation coefficient. So I'm going to go back to my worksheet. And what I need to do is I'm going to be given, as an assumption, certain correlations. All right, I got these, but I'm estimating 10 years, 2002 to 2012, just using the correlation function in Excel, and got these correlations. Money market versus cash, money market versus bonds, money market versus stocks, money market versus foreign stocks. And if I put if I put my 4 asset classes here, these 16 pairwise combinations of assets, this is every possible correlation. Say U.S. stocks with foreign, U.S. stocks with bonds, bonds with cash, bonds with foreign stocks. So these are all the different correlations I could have. Now to calculate a covariance matrix, what I actually need to do is I'll just calculate one for you, say U.S. stocks and foreign stocks. The covariance between U.S. stocks and foreign stocks is going to be the correlation between U.S. stocks and foreign stocks times the standard deviation of foreign stocks times the standard deviation of U.S. stocks. So that would be 0.03246. That's the covariance of foreign stocks and US stocks. Now you could just do that for all of these, and there's no easy way to really do this. I can't just anchor one of these and drag it over. I'd have to do each one of these where I reference the correlation over here and multiply times the 2 standard deviations. But let me just show you a trick, and there's a link to how this trick works. I know I need to take each correlation term times the 2 standard deviations. There's a trick to do this, and what it is, you just highlight this whole array, whole range, say equals, put in the correlation matrix, multiply times the 4 standard deviations. Now remember I said that the covariance term is the correlation times the 2 standard deviations. So I need to multiply times standard deviations again, but in order for it to work out just perfectly, that I get, say, foreign stocks and US stocks, 2 standard deviations, I have to multiply times the transpose. Now transpose is a simple function. It turns a row into a column. So I'll take the transpose of the standard deviations. So this is a trick, and there's a reference there if you want to see how it works, but if not, just use it. If I take all of that and I'm going to enter this as an array in Excel. When you put a formula across an entire range, you can't just put enter. You have to Control, Shift, Enter. Notice there's our 30246. What it's done, it has inserted this formula in every cell, and it's done it just so perfectly that I don't have to do every standard deviation times every correlation. So here is my covariance matrix. Again, what I said is, by definition, the variance of a standard deviation of a portfolio is the square root of the weights of each asset times the standard deviation, the double sum of the 2 weights and the standard and the covariance term. All right, now I'll give you the formula in Excel. Again, if you're interested in looking at how this formula works and how matrix algebra makes sure that this formula turns out just so perfectly, is you need to take a look at that link. But we're just going to be a user of this. So I'm going to take this formula. I'm going to go back to my Excel, and I have the formula written there for you because you're not required to learn it. So for this topic, we're just going to be a user. How are we going to use this is in Excel, uses matrix multiplication. So I need to do a matrix multiplication of the weights and the correlation matrix and multiply times the weights again and take it to the 1/2 power. Now, since this is an Excel function that uses matrix multiplication, just like arrays, you have to enter it by hitting Control, Shift, Enter. And there's my standard deviation of this portfolio, 16.66. Notice that 16.66 is 0.82% below the weighted average. This is the diversification benefit by adding these assets together, which are not perfectly correlated. Now, just for fun, I can show you this. If these assets were perfectly correlated and change all these correlations to 1, notice that that formula does give me the weighted average. So the only time the weighted average works is if the correlations are exactly all equal to 1, which never happened. So now I have my portfolio standard deviation formula based on this covariance matrix. I have the formula down here also. I'm going to take out that single quote and hit Control Shift Enter. There's my 16.66. Now once it's in there, I can just double click here to add it. These are my standard deviations of my portfolio over my entire lifetime, or Jordan's. All right, now over here, this is the last spreadsheet we did. All right, this is the one we showed that lasts till about age 95, or what was it, 91? So the end of year 90, she runs out of money at the end of year 91. However, again, that's a deterministic model. How do I make it a stochastic model? I'm going to assume that asset returns are normally distributed with these means and these standard deviations. If you remember for topic 8A, when we did Monte Carlo simulations for normal distributions, you can take the mean return plus the standard deviation times that random normal variable, which is norm S inverse rand. So I'm going to take that formula. It's the expected value plus a random variable, that's that random z variable, times the standard deviation. I'm going to enter that. Now every time I hit F9, that's a possible, I'm going to change the format back to percent. Every time I hit F9, that's a possible return that has a mean of 7 and 18 and a standard deviation of 16. If I did this a million times and I took the average, you'd see it'd be exactly equal to 7 and 18, and if I graphed it, you see that perfect bell-shaped curve. I'm now going to copy that down. Now every time I hit F9, every one of these rand functions here is going to give me a random portfolio return. So every time I hit F9, that's a random lifetime of earnings, or a random lifetime of portfolio returns based on these standard deviations and these means. Our last formula. Our portfolio starts out, let's expand this a little bit. Our portfolio starts out at $10,000. That portfolio is expected to grow by this random return. And we're going to contribute this $10,000 at the end of that year. So a portfolio starts out at $10,000, grows at this random return, plus my contribution. I'm going to copy that down. And what you see is this is the last 5 years of our life here. Get rid of some decimal points. Now every time I hit F9, I can see how my life ends. So this life does not look very good. It looks like the last 15 or 20 years I'm out of money. But if I hit F9, well, that one I just had just enough money. Oh, that one I ran out of money. That one I had just enough money. So what I want to do, the last thing I want to do, and this is part of one of the assignments I'll give you, is I can write a macro. All right, if you had topic 8A in the course, I showed you that you could take this value here, say the last portfolio value, and I could just copy as a value right here. Every time I hit enter, I get a new random set of portfolio returns. I can then copy that one and paste it here as a value. All right, so what I can do is maybe collect 10,000 portfolio values. Every time I hit enter, I get another lifetime of portfolio returns. And then what I could do to calculate the probability of whether or not Jordan is saved enough for retirement is I can then count. All right, again, think about copying this 10,000 times, maybe using a macro to do it. And I could just count how many of the 10,000 outcomes were negative. In other words, of the 10,000 possible lifetimes, how many times did I run out of money? And that would be a way to handle the risk in this portfolio investment choice. And if you're uncomfortable with the amount of times that you run out of money, maybe you should save more. Or maybe you should get into safer assets, maybe more bonds. But that's going to hurt you too, because that's also going to bring down the mean. So there's your basic trade-off in life. You know, the safer portfolio I have, the less variation and less big random changes I'm going to have. However, it's going to bring down the average portfolio because it's going to have a lower mean. So in this topic, we've talked about, going to just review, is if you start off with a budget, you can figure out that you need maybe 3 to 6 months of an emergency fund to have enough time to find that next job. You need life insurance of maybe about 10 times your salary. In this example, it's making sure that you can pay off a $500,000 mortgage and also replace your income for 20 years. We did a college savings plan where we forecasted we need about $5,000 a year to contribute to have just enough money to pay for college. And then in the savings for retirement, we showed that if you start in your 20s, you're saving, say, 12 to 15% of money, 12 to 15% of your income, you'll probably have about enough money for college. If you start, from my modeling and from what I've read from financial planners, is if you start right at age, say, 21, 22, 12% is probably reasonable. If you're starting in your later 20s, you probably want to start at maybe 15%. And if you do that, you'll probably have enough money for the rest of your life. And if we want to try to think about how portfolio choice, those portfolio standard deviations, affect your overall possibility of retiring with enough money, what you need to do is get portfolio standard deviation. And to get that, you first need to calculate correlations. Use those correlations to get covariances. Use those covariances to calculate the portfolio return, this nasty equation right here, which we can just use this equation to calculate. When I did that, I can then simulate possible lifetimes. And the last step I would probably do is run 10,000 iterations, copying this last number 10,000 times, and see the probability that I've had enough money. So the last thing I'll talk about is just a few investment principles. One, you got to save early. If you're 21 years old coming out of college, saving 12% is probably enough. If you're starting at 30, you probably need to be 15% or more. Second, avoid taxes. Use 401k plans. These are taxes that allow the earnings to grow tax-free and also saves you taxes today. 403b is just a 401k for nonprofits, and if your company doesn't have that, you'll have to do an IRA, which is kind of a 401k for yourself. Also, make sure you take free money. If your employer matches your 401k up to a certain percent, you have to at least save that. So many companies have, say, the first 3 or 6% of your 401k savings is matched. In other words, if you're making $100,000 and you save 6%, $6,000 into 401k, they'll put another $6,000 in there for you. Also, diversify across asset classes. You don't want to be all stock or all any one individual stock. You want to have a portfolio that has many asset classes, say stocks, bonds, cash, foreign stocks, and maybe some other asset classes. And you want the asset classes that have low correlations that give you that diversification benefit. And if you get one of those target date funds, it'll do that for you. You want to avoid fund fees and expenses. Also, the target date funds also are known to be very low fees. I generally look for expense ratios of about 0.2% per year. And lastly, I'd recommend that your portfolio choice of assets are indexed. In other words, the target date funds or your financial planner is not a stock picker. They're not spending millions of dollars paying some Wall Street professional to pick the right stocks. They just invest in, say, the S&P 500 for your stock exposure and just an overall bond fund. When you do that, you get lower fees, and also those funds have been shown to outperform more expensive funds. Bottom line, advice for a 20-something, save at least 12% of your first paycheck's pre-tax income in a tax-advantaged, low-expense fee, target date fund, and never, ever, ever stop contributing. If you want to know more, you can look at my YouTube video that does the portfolio matrix algebra for portfolio standard deviation and return. So it'll really explain what that MMULT all meant. If you want to learn about this consumption smoothing model, I have another YouTube video that explains a model that I've developed that uses the principles we just did. And if you're interested in that little function where we took the correlations times the 2 standard deviations and hit Control-Shift-Enter, here's a little primer on what it means to use array formulas in Excel. All right, and again, if you're interested, you can go to my Google site and also look in my YouTube page for an explanation of this consumption smoothing Monte Carlo model that I made for financial planning.